Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current. Mark, we're back. I know that we've been around the world, and I feel like every time you go to China, sometimes, or in just not China, in this case, in Asia, there's always a very big macro condition that changes. I'm not saying that it's causal. It could be correlated.
Causal. Yeah, absolutely. So, and look, I kind of, we did it again, the Carolina Blue, although after last week's debacle, I should not be wearing Carolina Blue. I do have a little flash of the bright yellow for your team this weekend since my team's off. But quick reveal, and then we'll talk about Japan. So Bitcoin orange today, and old school whale socks. One of the things that's been going on is there are two big whales, like early 2010-ish kind of whales who have been selling a lot of Bitcoin. Looks like they're about done, but that has certainly put some pressure on it. But yeah, macro is front and center. And yeah, I'm a little jet lagged still. Just came back from a week in Singapore, Hong Kong, and Japan. Hong Kong for the big Bitcoin Asia event, which was big, almost 20,000 people. And then the Metaplanet EGM a week ago, or actually earlier this week, that was, very well attended, about 3,000, 4,000 people. So
I think it's one of those things too, more where we're kind of combining some shows where I know you have the around the world, we've got our digital currents. So it's kind of nice to be able to give folks a little bit of the flavor of, what the global macro tenor is, because for such a long time, we saw Asia really being out in front when it comes to Web3 adoption in practical use cases. And dare I say, in cultist fanaticism of kind of some of these types of technologies.
Yeah.
What was the pulse that you're feeling now? Because I feel like that's kind of shifted. The US has become a little bit more culty. How's it faring?
I mean, for sure. So a couple things. I mean, look, there's definitely a movement, and I don't know if it's just a PR movement or if it's an actual movement in DC on this, the talking point of, making the US the crypto capital of the world. Now, what does that exactly mean? And of course, the Bitcoin maxis don't like the word crypto, so they don't want you to talk about anything except Bitcoin. But it's definitely a set of talking points. And so, the interesting thing for me is having just been in Asia versus here is people in Asia kind of walk the walk in the sense of, there's a lot of talk in the US and, some action. I mean, the Genius Act was real.
Right.
We still haven't got the Clarity Act, and we still don't have the Strategic Bitcoin Reserve Bill. But in Asia, people are turning out in force for events. There was a big event in Singapore 18 months ago, hugely well attended when, the numbers were kind of diving. And that was before the resurgence of Bitcoin Nashville, where the tide really turned here in the US, and, Trump jumped on. What was interesting, so Eric Trump, who's a special advisor to Metaplanet, was at the meeting. He was also at Bitcoin Asia, friendly with David Bailey. And he said on numerous occasions kind of how the family kind of got into digital assets because they were basically debanked
Mhm.
during the first run at the presidency. And so they were kind of forced to find alternatives, and they stumbled into Bitcoin and then other coins. And
And he seemed to be like the trailblazer, right, Mark? That's kind of how the story goes. He was the kid at the Thanksgiving little table that gets the bigger table when we get a little bit more shine on digital assets.
yeah, but it was interesting in that he echoed this. America wants to be the crypto capital of the world. Okay, that's fine, and it's one thing to say it, but then it's another to live it.
Mhm.
And when you look at what's happening over in different parts of it, because Asia's not one thing, right?
Yeah.
There's China, which is very different than Taiwan, which is very different than Korea, which is very different than Japan, which is very different than India. So there's definitely widespread adoption. So lots of people from all over the subcontinent showing up in Hong Kong for this event. But there's also a lot of builders building. A lot of interesting things. Jason Fang is doing some interesting things in other parts of Asia with Bitcoin treasury companies and Sora Ventures. So I love the energy of that part. I always have. I mean, look, I've been investing in China and Southeast Asia since the 90s. Lots of ups and downs and, positive vibes and negative vibes. But at the end of the day, such an innovative culture.
Mhm.
That's the big differentiator. And it's funny because if you don't go there and you just listen to Western media, you'd be like, oh, they're just copycats and we have all the innovation here and they're just stealing our stuff. And then you actually go there and you see the, superior technology, the better trains, better, how much high speed rail do we have in the US? Like, 1.6 miles or something in
Oh
New
God.
York. And it's just an interesting dynamic. It's the difference between talk, I said, and walk, right?
Right.
They are walking the walk and
100%.
gleaming cities, lots of great technology, high end devices. Korea leading in so many areas,
Sure.
and now really starting to extend their lead in areas in digital assets.
And to that end, Mark, I
So many
mean,
stories.
yeah, to that end, I think, the copycat mantra initially at least was fair if you just kind of think about
Sure.
durable goods, right? Because first they're produced there, and then there's kind of like a Costco Kirtland brand equivalent that is strictly Chinese. And then eventually there is a bit of an innovation that'll happen inevitably for the local market. And we're seeing now the US looking to imitate a lot of the innovation coming out west, at least as it comes for, synthetic financial products revolving around crypto assets. That we have to talk about, Mark, the beginning of Red September, for your background around there. We were thinking that this might be in the cards. We saw a dip to 107,000 to start this week, which, Mark, how far we've come when we talk about a dip to over
Yeah, the crash, the great crash of 2025 to, like I say, $107,000
Right.
per Bitcoin. And, look, at the beginning of the year, the idea that we would hit 6-digit Bitcoin was, it wasn't craziness, but there were a lot of people
Mhm.
who were like, oh, come on. And here we are at levels of I guess I'm conflating. So it was really the middle of a year ago. So 1 year ago, not the beginning of this year, but 1 year ago, the idea that we would hit triple digits was kind of crazy. And then we did in December, and then we kind of faded back down, and now we have run back. Now we haven't run as hard as some thought. There were a lot of people, looking for that, 200,000 number again. But the blocks, the interesting thing about the blocks is, the blocks are numbered and they're sequential, and we know how many at each event. And that, 4-year cycle we talk about is not exactly 4 years. It's about 5 or 6 weeks less than that. So, the 4-year cycle kind of rolls, and, it ended in December in 17, and then it ended in November in 21, and it likely ends in October this time. I think someone tweeted yesterday that the exact date. They said, we're 50 days away from the cycle peak. I'm like, that's pretty precise. But I think they're just doing it based on blocks. And we know every 10 minutes there's a block, and we know how many blocks until that event. So we'll see. But I think what's interesting is there hasn't been the same FOMO hype cycle this time, particularly in the retail side.
Mm-hmm.
The institutions are jumping in.
Right.
And, these Bitcoin treasury companies, there were sub 60 a year ago, something like that. Today, there's 160 odd and more, being formed every day. The Winklevoss twins announced theirs. It's not theirs, but they're participating in a new one by Nakamoto coming up here out of the Netherlands. So but my point there is they now own over 1 million BTC.
Wow.
That's a big number, right?
Sure.
I mean, you're talking about, close to 5% of available supply, probably a little over 5% because the lost or stolen. And that number's only going to grow because, at the Metaplanet meeting, Metaplanet is now going to issue preferred like strategy. And what is preferred? Preferred is essentially a hybrid security in between debt and equity, functions more like debt, got a fixed yield, and it's going to attract capital out of the moribund fixed income markets in Japan. There's $11 trillion of money market assets in Japan, basically earning nothing. And if you could make 5 or 6%, that's a lot better. And that will allow Metaplanet to buy a lot of Bitcoin. They have a target to own 1% of total supply, 210,000. They hit 20,000 this week, which is a big milestone. And, you think about how many companies, I think there's half a dozen now who have stated that goal, that they want to own 1% of the outstanding supply. And, strategies up to 3.5%. I think it's, just over 3.5%, just over 3% of total supply and rising. So, if you keep decreasing tradable supply, meaning you put increasing amounts in lockboxes, what happens to that value of the tradable? It's going to rise, right? It's supply and demand.
And I think it's one of those things too, Mark, where the idea of, not being overly reactionary, the dip, quote unquote, came to 107K. And then, what happened was something that didn't occur for many, many weeks, which is for the first time the BTC ETFs were in the green. So you had over 330 million in inflows, while interestingly, ETH reported net outflows of 135 million. So this is cool because we were talking about how, is ETH kind of where crypto traders are going now, following the swings? And that is precisely what happened in this week in the cycle. So I think, people were recognizing, hey, there's a discount here. Buying Bitcoin at 107K is a bit of a discount, which is amazing to say, an amazing statement. And, when we kind of, zoom out, throughout August, right, this past month, we saw that ETFs, they shed around on the BTC side, 750 million, while ETH gained 3.87 billion, right? And that was, for your point, the treasury companies were gobbling up a ton, like Bitmine. And so that kind of leads us to another story, Mark. It's something that we've been following very closely, and I know it's imminent, but the idea that there will be up to 90 new crypto ETF products, according to the SEC application. So some of the popular ones that we know about, XRP, of course, we love talking about those guys, Solana, Dogecoin. There's going to be a lot of throwing of spaghetti at the wall, Mark, to see what sticks. There's going to be a lot of people trying to pick up the bounce. And I think that, you're going to see potentially hundreds of crypto related launches here, because this is going to follow what you expected to see in blockchain, which was a lot of chains emerging because there's relatively little barrier entry. Now with favorable administration and policies, there's relatively little barrier entry for an ETF application. So those kind of are going to consolidate, but the same thing you got to imagine is going to hold true in probably the midterm. The short term, I think there will still be some speculation, which will drive prices. But in the midterm, there will be this flight to quality. And in the long term, it's going to be, anybody's guess about, is it going to be 2 protocols? Is it going to be 3 protocols? Is it going to be 5, like the internet? But in the midterm, there will be this slicing and dicing. But Mark, we have a moment ahead of us with up to 90. I think that, some will do well off the bat. What say you as you're looking at this period of just so many that are going to hit?
No, look, it's, there are critics, right, that say, what do we need these boomer wrappers for? It is supposed to be digital assets and people are supposed to own them directly. And you're not supposed to use, the security wrapper. Yeah, I mean, I understand, right? A purist would say, no, you hold your keys, you hold the asset directly, you have a digital wallet. Yeah, that is the future. The future is a DeFi, on-chain world. But it's kind of like this thing about, there was a chart going around last week that there are now more ETFs than stocks, right? There was the chart 10 years ago that said there were more mutual funds than stocks. Now there are more ETFs than stocks. Wow. Now, part of that is because the number of stocks keeps going down because the private equity companies keep taking them private. But the bottom line is the number, and you say, well, why can't people just buy stocks, right? Why don't they just buy them in their Robinhood account or their Charles Schwab account? And the reality is most people either don't have time or don't have interest or don't have affinity for trading individual names. They like the instant diversification of a mutual fund or now an ETF. ETFs are just, in theory, lower cost versions of mutual funds with some tax advantages. And so it made sense, even though the purists were like, no, you should just buy the stocks and not pay those fees. There's some benefit to having an expert or a professional, not necessarily all professionals are experts, but having a professional in charge and making sure that custody and safekeeping and, all things that have to happen. And I said, there are some tax advantages. And so I get it. Now you say, well, okay, let's do the same thing for this new set of assets, these digital assets. And, part of it is how many, just like in stocks, how many stocks do you need to own? do you just need to own the Mag 7? Do you just need to own the S&P 500? Do you need to own the Russell 2000? Or do you need to own a bunch of penny stocks and grifter stocks and crazy get-rich-quick schemes? I don't know. They all exist.
Sure.
And same thing here is, okay, there's a handful of pure cryptocurrencies. What I mean by cryptocurrency is a medium exchange or store of value. Then you've got some utility tokens. And then you got just thousands and thousands of meme coins and stuff that, is there really any use case for Dogecoin? No, not really, but it exists. And so should there be an ETF for Dogecoin? I mean, no, but if people want to own it and they don't want to deal with the wallet and they don't want to deal with the safekeeping and they don't want to deal with, that, are old school owners of assets going to utilize the boomer wrapper? And the answer is probably yes. And just like there are ETFs for microcap stocks that you may or may not want to own, people are going to own them. And there are ETFs, like Jets, I love to pick on this one. They own the airplane companies, like American and Delta. And really? I mean, if you want to own airplane companies, just, pick 4 or 5 and own them. But
right.
You really need an ETF for that. But that ETF had a bunch of money that went into it. So I think it's a long answer to say, yes, a lot of these ETFs are going to come on. Yes, people, I'll give you that. So, we've talked off and on maybe about DOG, right? It's a ordinal, a rune, and, it's an on-chain asset. They want to be the Dogecoin of Bitcoin because you're actually, on a real chain with proof of work. And the army, the DOG army, has reached out and said, hey, we should do an ETF. Like, yeah, I mean, I can see it. I can see it. And, but the issue is, what is DOG or Doge or any of these other, they are meme coins and they are not utility tokens and they are certainly not cryptocurrencies. Is there a place for them in people's portfolio? Could be. Yeah. So we'll see.
According to Clean Core Solutions, they announced a plan to spend, you're gonna love this, Mark, $175 million on Doge, becoming the first ever Doge treasury company. But I want to kind of go back to the idea of Red September, which we've spoken about through the years. This idea that dating back to 1928, you're seeing on average a worse month for stocks, and there are a variety of reasons for that. But there is also a self-fulfilling prophecy here, which also extends out to Bitcoin, which has declined by an average of 4% every September since 2013. So we have something that's looming on the horizon, which could be very interesting, right? On the 17th, we're expected to announce, 0.25% rate cut. Is kind of what folks are giving a high rate of probability. And so if that happens, the easy logic, although not necessarily the correct logic in every case, is that, folks are going to withdraw from some, type of cash bearing accounts and potentially look for some more risk on assets that could potentially bear a little bit more fruit like crypto. So, that may mean and spur on some buying opportunity. Mark, I don't know what it is, but today I'm feeling a little bit more pessimistic that September will be a little bit more of a trying month, but I'll put that in air quotes. In that
well, look, I mean, here's so the data is incontrovertible that on average, September is the worst month for equities.
Yeah,
over 140 plus years. It is the only month that on average is negative. It is historically been the worst performer of the 12 months. Now, the actual worst performance in any single month belongs to October. So we had the great crash in 87.
Right.
And we've had global financial crisis but on average, October hasn't been that bad. There's some logic behind why September's. So, you had the old saying, sell in May and go away and don't come back till St. Ledger Day, which, was the horse race in the UK around Labor Day in the US. And so basically people went on vacation and didn't trade. And so the markets just kind of meandered or went down. Now, the opposite happened this year is markets actually melted up slowly over the course of the summer. And then everyone comes back to work. They look at the valuation. They're, oh geez, and things go down. Now, from the perspective of overvaluation, we have the most overvalued stock market in history on every measure. Now, people say, well, yeah, but earnings are growing. Yeah, they are. But even with earnings growing, we're now at 5.3 times price to book. We're at the highest price to sales. We're at the highest price earnings. And you say, well, but that's all justified in this new world. Like, well, okay, fine. But at the end of the day, valuations are high. And could they go higher? Yeah, kind of, a little bit, not very much, but yeah. So probabilistically, September could be negative. That said, normally, when everyone believes something, it doesn't happen. And so the fact that everyone jumped on the red September and all the charts probably means that it isn't going to happen. Now, so you flip that, you say, well, okay, then what's going to happen? Well, the opposite of red September is October, right? That, October starts the Santa Claus rally. And there's some reason for that in that in 1980, it doesn't matter what year, I think it was 86, but there was a law that was passed for mutual funds. And it basically shifted the date of record from 12/31 to 10/31. So in the olden days, you had something called the January effect. And what was the January effect? Well, in January, stocks, particularly small cap stocks, particularly cruddy stocks, rallied like crazy. Well, why? Well, because the funds, the big mutual funds and institutions had to sell before 12/31, right, for tax loss harvesting. And then you have to wait 30 days to avoid a wash sale to buy it back. So people would sell their losers in December and then didn't want to wait till 12/31. So they did on like 12/15 or whatever. So then in January, they'd buy them back. And there was this January effect, small cap outperformed. Well, then the small cap effect went away. Well, it didn't go away. It just moved 2 months. So now what happens is in October, and it used to be end of October, and then it was kind of middle of October. Now it's actually, people keep front running each other. So they're trying to sell before everyone else sells. So now it's kind of the first part of October. You wait 30 days, and now that first week of November, second week of November, you get these. And so whatever was done poorly at the beginning of the year crushes it in November, and then they get this thing called the Santa Claus rally now. Well, the same thing was happening in digital assets in that you had this red timber and things got sold, and then you wait 30 days, avoid the wash sale, and boom, everything goes up October. And let's say everyone thinks that's going to happen, so therefore it doesn't happen. And one of the interesting things about all of this is the humans are going to human.
Right.
Humans are going to do what they do. And the rules, like for mutual funds and ETFs and all that, are what they are. And so that selling has to happen in October, right? And so that sets up the Santa Claus rally. But the pre-selling in September that starts to happen by humans can be offset by the machines. So now the machines are out arbitraging us, right? They're front running us and they're doing all these things, and they have bigger leverage and the big institutions. And, you know, I read this is a crazy stat. Citadel now, right? One of the largest hedge funds in the world, also a big market maker, now is involved in 25% of trading volume. I mean, that's a big number.
Conspiracy theory mark brewing. I don't know what is.
That's a big number. 25% is a big number. And so, and look, if you front run and what everybody else is doing, and you have insight, like, Citadel buys their, flow data from Robinhood, which Robinhood has just been on this tear, and SoFi and all these, platform trading stocks for, the day traders. I don't know. So we'll see what happens. My guess is, kind of like what happened to Carolina football last week. Everybody, and I do mean everybody, thought, Belichick coming to North Carolina, man, this was a lock. He's the guy, and he's going to attract this great talent, and he brought all these kids, and he's a great coach, and
well, Mark, they attracted a lot of talent. It was Michael Jordan, Mia Hamm, and all the retired athletes came.
Yeah, well, yeah, right, in the audience, right? And the problem is, everyone believed that it was going to be great, and I guess someone forgot to tell TCU, because TCU beat the crap out of Carolina in every aspect of the game, and it wasn't close. And so I think the same thing might happen here. Is everyone's convinced there's going to be, down market in the stock market, and stocks love to climb that wall of worry. And, the jobs number came out this morning, and it's Friday, we're recording this on Friday, and it was bad. I mean, like one of the worst in multiple years, and there's a big revision coming. So a lot of the jobs, quote unquote, that were created by the BLS, right? The Bureau of Labor and Statistics. I would say take out the L, right? It's the Bureau of BS. It's crap, right? They use this magic theory, the birth death ratio. And so they just make up numbers. And so they're going to revise down the jobs over the past year by somewhere between 500,000 and 900,000, which is a gigantic downward revision. And then, and this is my favorite. So in the way that the statistics work is when a person of my generation, the boomers, turns a certain age, you are removed from the workforce, despite the fact that you may still be working, or what actually is reported, you want to keep working. So there are 179,000, I think is the right number, people who have said they want to keep working, but they are no longer in the workforce. And so the unemployment rate this morning was 4.3%.
Right.
If you added back those people who are unemployed, even though they don't want to be, it'd be 7.8%. And that's an eye-popping kind of, well, that's a recession. Well, yes, it is. But if you don't count them, then it doesn't exist. And so there's all of these things happening that promote this illusion of everything's great. And things aren't great. I mean, look what happened to Lululemon stock, because people aren't buying as many spandex pants because they're expensive. And look at the restaurant stocks. Holy moly. If you look at all the restaurant stocks, they're just getting pounded. I was at a restaurant the other night with my parents, and there were 6 tables, X.
Wow.
And like you can't survive on 6 tables.
So,
and
certainly not
it's
when you
just,
pair that with the inflation numbers of just what the cost to produce, tends to be. And, I think it's one of those things where, we have this expectation for a rebound as consumer spending, tends to go in its most accretive part of the year, right? Where 50% of revenues are counted in just, 2 to 3 months. But if we're so kind of in the red to begin with, we won't have that momentum that'll kind of carry us through. But I'm curious, Mark, about what you may or may not have some thoughts about the weakening dollar, which kind of like ties this in. We were going to have
yes.
this as a chart of the week, but maybe it's worth just kind of leading into this idea where the global financial system has dominated USD as a reserve, currency. We're seeing this.
Look, it's the worst. It's the worst
right?
start to a year. I mean,
Mhm.
the year's almost over, right? I mean, not really, but here we are in September. So 3/4 or 2/3 of the way in, and the dollar is down 11%. It's the worst in 100 years, and it's just math, right? You can't raise tariffs and threaten, all kinds of actions against trade partners and expect to have business as usual.
Mhm.
And so if there's less trade, there's less demand for dollars. If there's less demand for dollars, the value of your currency is going to fall. And then on top of it, you destroy the value of the currency by running massive, and I mean massive, the largest deficit that we've ever seen other than 2020, which was, wind aided, shall we say, with the tailwind for a sprinter, by lockdowns. But, the quote unquote big, beautiful bill. And I mean, we're talking about deficits that are causing stresses in markets where, there's no bids. There's no bids for treasuries. Here's an interesting stat. So everyone looks at Buffett and Berkshire's cash holdings, right? Say, wow, he must know something. He thinks the market's going to crash. Maybe there's a different story. If no one wants to buy our treasuries, Chinese aren't buying them. They're actually net sellers. Japanese aren't buying them. They're net sellers. Russians aren't buying. They're net sellers. So there's only 2 people increasing their holdings of treasuries. The Brits, which is really not Brits, it's Saudi money in the UK, but okay. And the second is Berkshire. So they own over 5% of the outstanding T-bills right now.
That's a crazy stat.
It's a crazy
stat.
And you're like, well, maybe they have to do that. Maybe that's the price of entry. Like, every time there's a really great deal, Goldman Sachs goes on sale, or Bank of America goes on sale, or, United Healthcare went on sale. At the very, very bottom, somebody always gets the call to put in money in convertibles. So there's no risk, right? It's debt with a nice coupon, and then can convert to equity at a discounted price when the recovery happens. It's always Uncle Warren. And so he just got the call again for UNH. And so he went in, literally right at the bottom. I mean, the thing fell 70+%. He got to buy converts. And so maybe there's a quid pro quo that says, hey, you buy our treasuries that we can't really sell to anybody else, and we'll give you, the special deals. Now, the other place who's buying treasuries, it's interesting, back to crypto, is Tether. Now, remember, Tether is supposedly, air quotes, not a real company, doesn't really, they're cooking the books and it's bad people, and, all the rumors, the Tether truthers out there. Well, interesting thing, our Commerce Secretary, his firm, of course, he's not running the firm anymore. He let his son run it, but he's still involved and still a big shareholder. They own 5% of Tether. So Cantor Fitzgerald bought a big piece of Tether, and now Tether is the 8th largest owner of treasuries in the world, surpassing countries like Germany and others, and are on a trajectory. And then the stablecoin bill actually kind of whitelisted Tether. I mean, USDC is kind of the super whitelist, and then PayPal, but they went off the blacklist into kind of, I don't know, a neutral zone. So I just, there's a lot of stuff going on propping up what is otherwise, I always like to say, Newton was right. Gravity rules, and eventually things fall to their natural level, but you can prop up things longer than you think if there's concerted, consolidated effort to do so, which I would argue is exactly what's going on.
No doubt about it. And we know that Uncle Warren has plenty of time on his hands since announcing his retirement, and his beloved, beautiful merger, the divorce, is imminent between Kraft and Heinz. And, in the end, I guess just people want different alternatives. And, it's a recession looming potentially, Mark, when people just don't even want to buy Kraft mac.
Yeah, if you're not buying Kraft mac and cheese, that's bad. And to that point, the things that should be doing well, Dollar Store, Dollar Tree, Dollar General, McDonald's, and it's an interesting conundrum. I saw another thing. So there's been, I wish I remember the number. I think it's 21 trillion, I think is the number, of wealth that's been created in the last 25 years. Over 50% of that went to the top 10%. Another 45% went to the middle. No, I'm sorry. It was 60% went to the top 10%. Another 35% went to the middle, kind of 20th percentile down to the 50th. And then only 5% went to the bottom 50%.
That's wild. And I think this is a good point of transition, Mark, because our friends at Chainalysis provided a really good breakdown of just global crypto adoption. And I think this is where everything comes together. This idea of, Red September, it's an inevitability, it's a pattern, it's part of our behavior. But then there's this macro doom and gloom backdrop. And then also within the crypto, greed versus fear index, pointing towards some adjustment. Let's take a look at what this means on a global level. So I found this really cool interactive map from our friends over at Chainalysis that I would love your thoughts on. I'm going to try to share the screen here, and we can actually click in and take a look at, some of these regions in detail. So, we want to make sure that the U.S. is front and center. We hover over, we are at the silver rank over here as far as the global crypto adoption index. And what I was shocked by, amongst many things in this chart, is that number one is India, the most mercurial market there is when it comes to crypto adoption. And, if we play around with some of these, we see that Brazil is top 5, Argentina 20. Let's take a look at France, pick on them. At 22. So we're seeing, some regions here, but if we kind of collapse this and think about, what does this really mean for the broader regions? They have done that for us over here, great data. So let's click into this in a summary chart. or if we kind of look at this growth rate, which I think is the real compelling piece, we can talk about the absolute terms. No surprise, Mark, that the US and Europe dominate the total TAM because that's where all the dollars are, really. But if you look at the growth, and this is where you kind of can make the investment, APAC is dominating what was a 12-month period with a 69% year-over-year increase in just that. Let's call it what it is, more. It's an asset wealth transfer from fiat into the digital world. And the total transaction volume in APAC, Mark, is now grown from 1.4 trillion to 2.36 trillion. And you're really driven by India. So I just wanted to throw this up, Mark, so to get some food for thought, because this is a global perspective. And
it's a pretty amazing stat, given that, India has been very vocal about their anti-digital asset status for a long time, particularly anti-Bitcoin status. And yet digital asset and crypto broader usage has surged. And I think there are a couple of things that are at play here. One is, American exceptionalism, right? We think all the, activities here in the US and it's not. I mean, it's still growing and we still have aspirations to be the crypto hub of the world, but we're just not. And it doesn't mean that we're not active, and it doesn't mean we're not, not important, but this is a global phenomenon to the point of these charts. And I think most importantly, it's so much of the activity and so much of the innovation is happening outside US borders and outside the developed big three, right? It's not Europe, Japan, US. It really is the emerging world. Although, I would say it's hard for me to think of India as emerging. Now, certainly parts of India are clearly still emerging. But heck, parts of North Carolina are still emerging. Or China, is emerging, or Korea is an emerging market, and Korea is not an emerging market.
But then you've got, Mark, here also LATAM is a close second with 63%, and they were already pretty high. And you have, significantly smaller cities, relatively speaking. Obviously, you have Mexico City, Buenos Aires, Rio. But in general, that's a youth movement, and we were all over that with kind of our investments in.
Yes. I mean, you look, you have been the leader in our area there of focusing on LATAM, focusing on these emerging technology companies, and I think this is a great example again of the leapfrog effect, right? Which is when you don't have incredibly entrenched incumbents and technical debt and infrastructure that you have to displace. It's like cell phones, right? Why do cell phones work better in sub-Saharan Africa and India and Argentina than they do in New York City or here in Chapel Hill, where the NIMBYs rule? It was because the incumbents like their fixed wireline revenue base, and they don't want to cannibalize them with mobile. Well, if you don't have copper wire strung up all over your country, you can, use cellular technology. And the same thing here is, if you think about where most of the people in the world, I mean, here's a crazy stat, right? 40% of the people in the world don't have a bank account.
That's insane.
It's an insane number, right? So, but the vast majority of that 40% do have a mobile phone. So you can go to a place like Nairobi, Kenya, and you can use your mobile phone and your mobile minutes kind of like currency. And it was natural for them to migrate into digital assets. Or you can go to Latin America and it's natural, right, to trade in the digital world. You look at Mercado Libre and how fast they've grown and how great that business is, and to extend payment rails based on digital assets, and remittances is a big business, and it's better to get remittances for free than 30% with Western Union. So
Sure.
all of these things factor in, and I just think it's an openness and a willingness, but more importantly, it's a necessity, right? If you don't have great infrastructure in parts of rural India, and you're comfortable with this idea of digital through this, Aadhaar system, everybody's got a digital ID already, and you say, hey, I can use this digital payments company or this crypto payments company. Yeah, I'm in. And if you're a rural farmer and you need to get seeds, and you can make your payment and have less carrying costs or transaction costs, you're going to do that all day. So I do find it interesting how we still have this kind of U.S. centric view of the world. I joke, since it's football season, it's like, Americans are like Notre Dame football fans. They remember a past that never was. And it's not that it was never great. It's not that Notre Dame was never great. We were in the 1940s, but it's been a long time since we were totally dominant. Now, we made the national championship last year, whatever, and we're a good football team, and it's
great uniform. One of
great
the uniforms.
Yeah. I mean, great uniforms, and the culture is great, and the experience going to a football game in South Bend is amazing. We know how to tailgate, but at the end of the day, it's just, there's a lot of great football teams, and there's a lot of great experiences, and there are a lot of great innovators and a lot of great countries out there doing things that are leading the pack. And so I love the fact that we now aspire to be leaders. I love the fact that we, and again, we could quibble a lot about the administration and good and bad, but one thing that is good, and to me it's incontrovertibly good, is pushing for the adoption of digital technology.
That we can agree on.
Not going down the path of a surveillance state, CBDC, and, wanting a decentralized future. Now, some would argue, but they're allowing things like XRP to have hope that they're going to be involved. They're probably not going to be involved. And they can allow, the other, shitcoins, and why does Trump have a family coin, and why do they get to do this public company and this new token? Look, the Emollients Clause is not as enforced as it once was. And look, greedy people are going to do greedy stuff. And that's been happening at the world leadership stage for a long time. I mean,
Agreed.
Arguably the richest man in the world isn't, Elon Musk or Bill Gates. It's Putin. Now, I don't know if that's true or not, but reports are that, he has a little piece of a lot of things, and he's a super, super wealthy guy. And there are plenty of people around the world that have done similar things. And
well, the good point that you always raise, Mark, and you double tap it, is that, crypto isn't the enemy. Granted, the regulation will continue to improve and evolve, but it just creates a conduit for people that are seeking to game the system or do, bad things. It just provides them another avenue to do that. That's not the purpose of doing so. You can create a bridge for people to go and rob banks, but then also that bridge allows people to go to work. So you.
Oh no! Look, the whole idea that the rails or the infrastructure is the culprit is just silly, right? To your point, we have highways, and terrorists drive on highways. So do we hold the highway manufacturers liable? They fly on airplanes, or they use boats, or they buy munitions. I mean, and we actually make the munitions that they're buying. So bad people are going to do bad things.
Correct.
But technology in and of itself is not evil.
Correct.
And the technology that we have today to decentralize the world and have better forms of money like Bitcoin, and have better computing platforms like Ethereum, or Solana or others.
Mhm.
It's just better. And so I get why people conflate. I get why they want to preserve their own wealth and they don't want to share. And look, I get why Visa and MasterCard don't like digital payment rails, because if I could take 3% of every transaction in the world, I would like that business. And if now someone's going to do it for 1%, I understand why you wouldn't like that and why you'd want to stop them from doing it. But the inevitability of better technology has always worked out.
Yeah.
And I would say, name a technology that got to critical mass that you put back in the bottle. It just doesn't happen. Now, there are a lot of technologies that get delayed.
Electric car, Mark. It almost happened with the electric car.
No, it did. No, that's a good point. It did. You're right. And it took a better part of 100 years. You're exactly right. 1903, largest car company in America was American Electric Vehicle Corp. And Henry Ford and John D. Rockefeller did a good job putting that back in the bottle for the better part of 100 years. So you're right. It does happen.
But we did come back around here. But I think that's probably a good place to cut things. We want to welcome you back, Mark. We know you're struggling through not being at full strength. Lesser Man will cancel. But this is a cool chart. Instead of links to check out, it shows the bigger picture and kind of why it's so important to talk about both TradFi and DeFi, because they're converging. And we thank our audience as always for tuning in. Make sure to rate, review, and subscribe. And as always, to stay current. Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.